Developing the long-term plan comes down to a few simple steps. Step number 1. Forecast your sales. It always starts with a statement of profit and loss. Sales forecast is generally based on the past trend in sales and the influence of any anticipated events that might materially affect the trend. Forecasted sales may increase based on the target increase in the market or due to the increase of the market itself. For example, if a business is targeting an increase of 10% from the existing market, your sales forecast thus can be a growth of 10% for the following year. Next is compute the dividend payout ratio and the plowback ratio. A dividend is the distribution of some of a company's earnings to a class of its shareholders as determined by the company's board of directors. What is a payout ratio? A payout ratio is a financial metric showing the proportion of earnings a company pays their shareholders in the form of dividends, and it is expressed as a percentage of the company's total earnings. In some occasions, the payout ratio refers to the dividends payout as a percentage of a company cash flows, and payout ratio is also known as the dividend payout ratio. If, for example, the business is paying cash dividend, the formula will be the dividend divided by net income. If business does not pay cash dividend, then it is equal to 0. Now, the plowback ratio, or also known as retention ratio, is 100%. So, what is a plowback ratio? A plowback ratio is the proportion of net income that does not get paid out in cash dividends. So, here is an example. In example, given are the earnings, which is 5 million pesos, and dividends of 3 million pesos. Now, how did we get the payout ratio of 60% and flowback ratio of 40%? First, we compute for the payout ratio, 3 million divided by 5 million will get 0.6. And we have to we have to use the percentage format. So we multiply 0.6 to 100 to get 60% payout ratio. Remember, flowback ratio or retention ratio is 100%. If payout ratio is already 60%, then in order to complete 100%, we'll have 40% as a flowback ratio. This is another example. Let's assume company XYZ reported earning per share of 50,000 pesos last year and paid 10,000 pesos in dividends. Using the formula above or from the previous slide, what is the payout and the flowback ratio of company XYZ? So the answer will be, since we have or the given are the earnings of 50,000 pesos and dividends of 10,000 pesos, and we'll use the formula dividends divided by net income, we'll have 10,000 pesos divided by 50,000 pesos is equal to 0.2 times 100, then we'll have a payout ratio of 20%. And to make this 100% for the flowback ratio, it's 100 minus 20% will get 80% flowback ratio. Number 3, identify your spontaneously generated funds. From the word spontaneous, which means done naturally, okay, it comes as a result of normal business operations. When we say spontaneously generated funds, these funds are obtained automatically from normal operations, and they include increases in accounts payables and accruals or accrued expenses. Spontaneously generated funds or accounts are the accrued expenses and accounts payables because they will naturally increase as a result of a higher sales or as a result of changes in sales because we are projecting that there will be an increase of sales for the next year. Number 4, use the percent of sales approach to prepare the pro forma financial statements. But what is pro forma? When you say pro forma, it is a Latin term that means for the sake of form or as a matter of form. It refers to a method of calculating financial results using certain projections or presumptions. Pro forma financial statements should emphasize projected figures. From the example earlier for step number 1, our projection is a 10% increase in sales. So, pro forma financial statements should show a 10% increase in sales. But how are we going to make a pro forma financial statement? Or how are we going to use the percent of sales approach in order for us to prepare a pro forma financial statements? We divide expenses, assets, and liabilities by the sales figure. Number 5, calculating external financing need, or it is also known as additional funds needed, EFN, and discretionary financing needs. But what is EFN? It is the required additional financing through the additional issuance of interest-bearing debt and common stock to acquire the needed assets. Now, here is an example on how we can compute or calculate your external financing need. First, we have an income statement. Let us say sales are forecasted to grow 20% next year. Obviously, it will translate to a 20% growth in assets. Then, use the percent of sales to approach to calculate the weights needed in preparing the pro forma income statement. So as you can see, cost and net income were 55% and 31.50% of sales respectively. Furthermore, the dividend payout ratio is 0%. So meaning the company is not paying cash dividends. Now, the question is, how did we get the percent of sales? We divide them to sales. So this is an example. It's cost divided by sales and then you'll get the percent of sales. Next, how about if the company is paying cash dividend payout ratio? If, for example, we have 300,000 here, or the company is paying 300,000 dividends, we have to get the payout ratio first. How do we get the payout ratio? It's dividends divided by net income, and then we'll come up with 10.28%. Okay? Now, since there is no dividends, what will be the addition to retained earnings? Addition to retained earnings will be the same with net income. But if there is a dividend payout ratio, um, all we have to do is to follow net income minus dividends, or 2,919,519.23 minus our dividend of 300,000. Then that will be our addition to retained earnings amounting to 2,619,519.23. Again, if there is a dividend payout ratio, all we have to do is deduct our dividends to net income, and that will be our addition to retained earnings. But if there is no dividend payout ratio or the company is not paying dividend, then all we have to do is to copy the net income to retained earnings. Now, to prepare a pro forma income statement, we have to remember that sales are forecasted to grow 20% for next year. So, our projected sales now will have a 20%, or you have to write 20% here in order for us to identify that in this pro forma, projection is 20% increase in sales. But how did we compute for 11,121,978? So it will be, so let's base on our income statement. So that is sales multiplied by 20% and then you add the sales figure. So it's 9,268,315 times 0.20 or 20%, you'll get 1,853,663 plus your sales of 9,268,315, and then we'll get the resulting figure 11,121,978. Next, in order for us to get the amount of cost, we have to multiply the resulting figure or the projected sales to 55%. So that's how we'll get the 6,117,087.90. And then to get the taxable income, projected sales minus cost. That's taxable income. And then taxes or the 30% tax is given, all we have to do is get the 30% of our taxable income. And in this pro forma income statement, our tax is 1,501,467.03. Yeah. And then, to get the net income can be your taxable income minus your taxes. Next, so in order for us to get the addition to retained earnings, um, we'll get, or if there is a dividend, just like the example earlier, uh, if this dividend is 10.28%, you get 10.28% of the net income. And then you'll have the amount here for dividends. And net income minus dividend, that will be your retained earnings. But since in this example, we're not paying cash dividends to shareholders, so all we have to do is to copy or retain or just copy the net income to addition to retained earnings, meaning the amount will be the same. So that is our pro forma income statement. Now, let's proceed to the balance sheet. Okay? For balance sheet, all we have to do is to get the percent of sales first. So, meaning the 16%, 44%, 60%, we have to get, or we have to know first, how did we get this percent of sales? So, we divide the cash amount in cash and cash equivalents from the balance sheet to sales of income statement to get the percentage of sales. So, let's the figure of cash and cash equivalents divided by your sales in the income statement. And then we'll follow the same process for other accounts. So uh, we'll follow the same process for accounts receivables and for the inventory. And as discussed earlier, for the current assets, the percentage of current assets, all we have to do is to get the sum of all current assets, then you'll get 120%. Next, for PPE, we'll follow the same process. And of course, the accounts payable and accrued as expenses. And then the rest, the figure will be retained. Why do we have to get the percentage of accounts payable and accrued expenses? Remember, these two accounts are spontaneously generated funds. Okay? Now, in creating a pro forma balance sheet or in making a pro forma balance sheet, okay, it is important that our percent of sales are accurate or are correct. Now, let's multiply the weights or the percent of sales by the projected sales figure. This process will be applied to all asset accounts. Then, summing them up, we'll be able to get the forecasted sales percentage, which is 20%. Okay. this is our balance sheet. So all we have to do is to get the projected sales figure from our pro forma income statement and then multiply it by the percent of sales. Okay. So we follow the same process from all or to all to total assets and to all spontaneously generated funds. So that is up to accounts payable and accrued expenses. So that's how we got this amount. And then for notes payable to owner's equity, we get or we'll just have to transfer or we'll use the same amount or the amount will be retained. But how about for owner's equity? There will be changes for owner's equity since the retained earnings, okay? Earlier, our retained earnings for balance sheet is around uh, 7 million 7,052,661.60, and then we have to add the retained earnings from our pro forma income statement. So we'll have the new retained earnings of 10,556,084.67 in pro forma balance sheet. Okay? And then, so since we got the total assets, okay, the total liabilities plus owner's equity. But how are we going? Since this is not balanced, we need or we have to identify how much is the difference in order for us to balance our assets and liabilities and owner's equity. So the difference between the two will be our EFN or our external financing need. So we have to deduct our total liabilities and owner's equity to total assets. The answer will be 1,316,100.73. So how are we going to translate or how are we going to explain the result of this EFN? Remember, a positive EFN means the company will need additional borrowings or additional capital, while if the EFN is negative means the business will have extra funds. Going back to our balance sheet, the answer is positive. So the explanation will be the company will need additional fund of 1,316,100.73 centavos in order for the company to achieve the projected sales of 20%. Okay? So that's it for this lesson. If you have any questions, you may send me a message. Thank you.